One single mistake in your retirement account can cost you tens of thousands of dollars. Today, I'm going to show you 5 critical Roth IRA mistakes that people over 50 in the US are making. You're probably making at least one of these mistakes. Let's get started right now. Now, let's connect with David Montgomery.
Hello everyone, I'm David Montgomery. I've been doing financial planning for 30 years. Today I'm going to share some really important things with you about Roth IRAs. Every day I see at least one of these 5 mistakes in clients who come into my office. And these mistakes really cost a lot of money. So listen carefully. Mistake number 1. Beneficiary designation error. You absolutely must designate the right beneficiary on your Roth IRA account. There are 2 options here. The first is beneficiary. The second is spouse as beneficiary. If you're married, make sure to designate your spouse as spouse beneficiary, not just as beneficiary, because the difference is incredibly huge. Let me give you an example. Let's say Jim and Sally are married. Jim has $75,000 in his Roth IRA account. Jim passes away. If Sally is designated as just a regular beneficiary, do you know what happens? Sally gets the money. She doesn't pay taxes because it's a Roth IRA. But there's a big problem here. For her to transfer that money into her own Roth IRA account, she needs to have the contribution limit available. In 2025, the Roth IRA contribution limit for those over 50 is $8,000. So Sally can't transfer $75,000 into her account in one lump sum. She can only do it within the annual limits. But what happens if she's designated as spouse beneficiary? That's when everything changes. Sally can transfer Jim's entire Roth IRA account directly into her own account. Unlimited. All at once. Without paying taxes. Now, think about this. Both Jim and Sally have Roth IRA accounts with $80,000 each. Jim passes away. Sally is designated as spouse beneficiary. What happens? Jim's $80,000 is added to Sally's account. Sally now has a Roth IRA account worth $160,000. But what if Sally was only a regular beneficiary? That $80,000 would go into a regular investment account. An account without tax protection, even if it earned 4% a year. That's $3,200 in dividends and capital gains. That means thousands of dollars in taxes. It could even reduce your Social Security payments in some cases. In short, if you're married, designate your spouse as spouse beneficiary. This small detail protects the wealth in your family. Go check right now, because most people make this mistake. One more detail. If you don't have a spouse, you can designate your children or loved ones as beneficiaries, but they don't get the same tax advantages. Inherited IRA rules apply to them. They need to empty the account within 10 years. Still, it's much better than not designating any beneficiary at all. Because without a beneficiary, the account goes through probate that can take months and is costly. Mistake number 2. Using Roth IRA like a savings account. This is a very common mistake. People use their Roth IRA accounts as if they were bank savings accounts. They leave it at 1% or 2% interest. Folks, this is a big mistake. A Roth IRA is a long-term investment tool. Think of it like a 401k. It's designed for growth toward retirement, not just for saving money. In 2025, high-yield savings accounts are averaging 3 to 4% interest. There are online banks like Marcus Alley Bank, but that's not enough, especially for a tax-advantaged account like a Roth IRA. Think about it this way. You put $10,000 into your Roth IRA. You keep it at 3% interest. You earn $300 a year. Yes, you're earning it tax-free, but $300 is a very small amount. But what if you invested that same $10,000 in a diversified portfolio? Index funds, stocks, bonds. Historical average of 7 to 8% return. In that case, you're earning $700 to $800 a year. Still tax-free. Do you know where this difference leads over 30 years? At 3% interest, $10,000 grows to about $24,000 in 30 years. But with 8% return, the same money goes over $100,000. See the difference? More than $75,000 difference, just by putting your account in the right investment vehicle. Of course, there are some situations. For example, if you're making a down payment on a house in 2 or 3 years, then a high-yield account might make sense for the short term. But if you have 15 to 20 years until retirement, you absolutely must apply an aggressive growth strategy. The biggest advantage of a Roth IRA is tax-free growth. If you're not using that advantage, there's no point in opening the account. So go check your portfolio. Are you just saving money or are you actually investing? Mistake number 3. Contributing to Roth IRA while having high interest debt. This is a logic error. There's very simple math behind it. If you have credit card debt and you're paying 18% interest, pay off that debt first, then put money into a Roth IRA. Think about it this way. You have $10,000 in credit card debt. Interest rate is 20%. Every year you're paying $2,000 just in interest. But at the same time, you're putting $5,000 into your Roth IRA account, and that money is earning 8%. Of course, mortgage debt is different. If your mortgage interest is 3 or 4%, there's no rush, because you can earn 7 to 8% from Roth IRA. In that case, investing makes sense. But for high-interest debts, the rule is simple. If you have interest rates of 8, 9% and above, pay them off first. Credit card debt, auto loans, student loans. Clean these up first, then aggressively contribute to your Roth IRA. As you can see, finance isn't just about opening accounts. You need to think strategically. You must use your money most efficiently. Otherwise, you're earning on one hand while losing on the other. Mistake number 4. Trying to withdraw and redeposit in the same year. This mistake confuses a lot of people. Understanding the contribution and withdrawal rules in Roth IRA is very important, because if you do it wrong, the IRS will penalize you. Let me explain step by step. In 2025, the Roth IRA contribution limit for someone over 50 is $8,000. Let's say you deposited $8,000 in January. Great. Your limit is full. In June, you faced an emergency. You needed to withdraw that $8,000. You withdrew it. No problem, because you can always withdraw your contribution amount from Roth IRA. No penalty, no tax. But in August, that emergency passed. You want to put the money back into the account. This is where the problem starts. You can't. Your limit for that year is done. You must wait until January of the next year, because IRS rules are like this. Your annual contribution limit is $8,000. This is about how much you contributed in total during the year. Withdrawing money doesn't reset that limit. So, how is it solved? If you didn't fill your full limit from the start, for example, you put in $4,000 in January. You withdrew $4,000 in June. You have the right to deposit $4,000 more in August, because in total you're reaching your $8,000 limit. But if you deposited $8,000 from the start and withdrew it, you need to wait until next January. Otherwise, you'll get an excess contribution penalty. The IRS applies a 6% penalty on every excess amount deposited. 6% per month. It adds up very quickly. People think like this: I withdrew my own money. I'm putting it back. What's wrong? But the IRS doesn't see it that way. For them, this is a new contribution, and it means exceeding the limit. So if you're going to withdraw money in an emergency, plan well. Know that you can't put it back again within the same year. You must keep that money somewhere else until the next year. Maybe in a regular investment account, but you can't put it back into the Roth IRA. Many people who don't know this rule get penalty letters from the IRS. Then they make repayments and pay penalties. It's a very unnecessary expense. So learn the rules and act accordingly. Mistake number 5. Withdrawing money without tax planning. This mistake is a more strategic issue. Most people haven't even heard of it, but it's incredibly useful. Let's say your Roth IRA account is full. There's $80,000 in it. At the beginning of 2025, you need to make a big expense. Maybe you need $25,000. Home repair, car purchase, whatever. What do most people do? They withdraw that money in January or February. use it, then during the year, they find money somewhere. Maybe an inheritance comes. Maybe they get a bonus, and they want to put that money back into the Roth IRA. But they can't. Because as we explained before, you can't withdraw and redeposit in the same year. So what's the solution? Tax planning. If you know you'll need money at the beginning of 2025, withdraw that money in December 2024. That is, at the end of the previous year. Why? Because this way your contribution, right, for 2025 stays clean. You withdrew money in 2024. In 2025, you have the right to make a new contribution. $8,000. Now, let's say $15,000 came into your hands in July. What do? You put $8,000 of that money directly into your Roth IRA. Because you didn't make a withdrawal for 2025. You're only making a contribution. What does this gain you? If that $8,000 grows at 8% in the Roth IRA, that's $640 a year. Tax-free. If you kept that money in a regular account, it would be taxable. Federal tax, state tax, capital gains tax. If you're in the 25% tax bracket, you'd pay $160 in taxes. See? Just by planning 1 month ahead, you can save $160 a year. Do this for 10 years, $1,600, plus compound earnings. It can reach $5,000 to $6,000. This tactic is golden for people approaching retirement, especially because cash flow management is very important. You need liquidity, but you don't want to lose tax advantages. Also remember, you can withdraw your contribution amount from Roth IRA anytime. No penalty, no tax. But if you withdraw earnings before age 59 and a half, there's a 10% penalty. So only withdraw the contribution amount in emergencies. Don't touch the earnings. This way you provide liquidity and don't pay penalties. I do this with my clients constantly. When year-end comes, I ask, is there a big expense in the next 6 months? If there is, we withdraw that money in December. This way, the contribution right for the new year is preserved. Nobody teaches you this, but this is real financial planning. Small details make big differences. Knowing the tax codes and using them in your favor.
So folks, these are the 5 most common Roth IRA mistakes: beneficiary designation, investment strategy, debt management, contribution rules, and tax planning. Each one separately can cost you thousands of dollars. But now you know, you watched this video. You won't make these mistakes anymore. Go check your accounts today. Are your beneficiary settings correct? Is your money just sitting in a savings account? Do you have high-interest debt? Do these checks and apply the necessary changes immediately. Because retirement planning is not something to postpone. Every day you postpone these decisions is costing you money. If this video added value to you, don't forget to hit the like button. Write your questions about Roth IRA in the comments. I'll answer all of them. And subscribe to the channel because every week I prepare videos for you on retirement planning, Social Security, 401k, IRA, and passive income topics. I wish you healthy and wealthy days. See you in the next video.